When a private company decides to sell shares to the public for the first time, it faces a mathematical challenge, determining the exact monetary value of its stock. The company lacks certain data on market demand, while potential investors lack full visibility into the company's internal operations. Historically, markets relied on the fixed price method. Underwriters would examine the financials to set a static valuation. Setting this price too low results in millions in lost capital, while setting it too high leads to a failed offering and total market rejection. This diagram compares the two models. On the left, the traditional fixed price method locks the valuation to a static estimate. On the right is book building. Instead of dictating a price, the company opens a dynamic order book where institutional investors place bids based on their own internal valuations. By analyzing this aggregate demand, the market discovers a cutoff price. This shift ensures that the market, rather than the seller, dictates the final valuation of the asset. In 2020, the Securities Board of Nepal, or SEBON, introduced book building to the domestic market. The guidelines were framed as a modernization effort designed to increase market efficiency. The results have contradicted the scientific intent of the model. In Nepal, the implementation of book building has coincided with systematic losses for retail investors. Nepal's book building system functions as a wealth transfer mechanism, enabled by specific structural gaps in its regulatory design. The destruction of retail wealth in Nepal is driven by a series of regulatory omissions, centered on the absence of a mandatory minimum public float. Under the book-building model, the price retail investors eventually pay is established during an initial bidding phase restricted to qualified institutional buyers, or QIBs. These institutions submit bids, and the price that clears the available supply becomes the official cutoff. The validity of this price depends on the free float, the percentage of total company shares legally available for public trading. This supply and demand chart shows a standard high float scenario. When a company releases a large percentage of its shares, such as 35%, the volume of supply requires broad participation to be absorbed. The intersection of institutional demand and high share supply naturally produces a price closer to the company's intrinsic value. The math shifts when supply is restricted. If a company retains 90% of its equity and releases only 10 to 15% into the IPO, the supply curve moves inward. The same institutional demand interacting with this artificial scarcity pushes the equilibrium point to an artificial peak. In Nepal, this restricted supply is often bid on by a small circle of fewer than 90 approved institutions. When a limited group of bidders competes for a deliberately constrained supply, the resulting price reflects scarcity rather than value. Without a high free float, book building loses its integrity as a pricing mechanism, and instead provides the structural leverage needed to manufacture an inflated IPO price. Global regulators recognize that low float creates the conditions for market manipulation. To prevent this, they mandate minimum share distributions in their listing requirements. In the US, the SEC and major exchanges require a minimum public float, often between 10% and 25%, before a company is allowed to list. Standards in Asian markets are similarly firm. India's SEB enforces a 25% minimum public float for listed companies, while the Singapore Exchange maintains strict rules to ensure shares remain in public hands after the initial listing. This comparative matrix tracks these global standards. Look at the row for minimum public float. While the US, India, and Singapore strictly mandate these percentages to ensure market depth, Nepal's 2020 book building guidelines omit this requirement entirely. The absence of a minimum float requirement serves as an explicit regulatory permission for market manipulation. We can map the specific mechanics of this loophole by looking at the Sarbottam Cement IPO, which utilized a 4-layer extraction system. Layer 1 is pre-IPO insider distribution. Before the public offering, insiders and regulatory affiliates utilized their access to acquire Sarbottam shares at a private price of just 250 rupees. This network graph tracks the price escalation. While insiders secured a baseline of 250 rupees, Layer 2, the QIB illusion, took effect. The company released only 12.9% of its shares. A small group of institutional bidders competed for this tiny float, driving the cutoff price to 750 rupees. This locked in an entry price for the public that was 300% higher than the insider rate. Layer 3 is the FOMO pump. Because only 12.9% of the company is trading, the secondary market price is pushed even higher by artificial scarcity. This lures in retail investors who buy at the peak, fearing they will miss a rare opportunity. The fourth layer involves the promoter lock-in period. This is the duration during which founders and insiders are prohibited from selling. While India mandates a 3-year hold to ensure stability, Nepal's guidelines allow promoters to exit after just 1 year. Looking back at our graph, we see the inevitable result when that lock-in expires. The remaining 87% of the company's shares suddenly hit the market. The artificial scarcity disappears, supply overwhelms the system, and the retail price collapses back toward the 250 rupee baseline. The retail investors buying at the top provide the necessary exit liquidity for insiders who bought at the bottom. These mechanics are the result of regulatory capture. This occurs when a regulatory body functions as a shield for the financial interests of the industry elites it is supposed to oversee. During the Sarbottam case, investigations revealed that family members of both the SEBON chairman and the CEO of the Nepal Stock Exchange had acquired pre-IPO shares at the 250 rupee baseline. The very regulators tasked with ensuring fair pricing had a direct financial interest in the inflated public offering. This capture has severe macroeconomic consequences. It diverts national capital away from productive industries and into rigged secondary markets. When the system is designed for extraction, genuine enterprises are less likely to list, and capital is not used to grow the economy. When a national capital market loses its fundamental credibility, the resulting structural wealth inequality harms the entire economy. Fixing Nepal's capital market does not require removing book building, but rather installing the missing regulatory architecture. The blueprint for essential fixes. First, mandate a 25 to 30% minimum public float to restore supply and demand integrity. Second, enforce real-time transparency for institutional bidding to prevent collusion. Finally, extend the promoter lock-in to 3 years to ensure long-term focus over quick exits. Price discovery requires market friction, absolute transparency, and genuine liquidity to function. Advanced financial tools are ineffective without regulatory integrity. When a watchdog facilitates the extraction of public wealth, the market itself becomes the ultimate liability.